Welcome. My name is Sasha Moore, and I'm delighted to moderate today's Trail Book Amplification webinar. So as the name would suggest, we're holding this event to provide brokers with greater insights and an understanding of how to receive up to 3 times the annualized trail for the purchase of their book through the release of an exciting new product that's never been seen before within industry. This webinar is suited to brokers with a robust, established business seeking to raise capital. This will usually be to invest in their business, buy out a business partner, or sometimes in the case of a divorce, a spouse. It's also suited to brokers seeking to purchase a broking business as part of their growth escalation strategy. And lastly, for brokers who might like to take some capital out of their business to retire debt or make a significant purchase, whether or not that's business related. We have with us today the industry veteran and trail book guru, Nick Young, who's the managing director and founder of the leading trail book company, Trail Homes. Welcome, Nick.
Hello there, Sasha, and good afternoon, everybody.
Indeed. So let's get cracking. So to give you a summary, what we're going to focus on is what's happening in the current market and how it's affecting trail book values, how a trail is valued, including why the runoff rate is such a driving factor, and how to achieve between 2.4 and 3 times the value of your book based on 2 pricing models whilst keeping your clients. So we love questions. Be sure to feed through as many questions as you have via the chat function, and we'll get through as much as possible. If they're very specifically related to what Nick's talking about, we'll address that at the time. Otherwise, we'll have a Q&A session at the end. So, Nick, let's start. What's happening in the market right now, and how is that affecting trail book values?
Well, it's been, we've come through some pretty unprecedented times. So if we wind the clock back to that terrible COVID period, we had a lot of quantitative easing, which all brokers would be very much aware of, and it was possible to refinance somebody into a fixed rate loan at less than 2%. And the mortgage broking industry and Australia as a whole embraced that pretty damn heavily. So there was an extraordinary amount of refinance activity going on through that latter part of COVID. Now, what that meant is that our runoff rates were running higher than normal. We then rolled forward, and just when we thought that we were going to return to normal times, the banks, lenders, noticed unilaterally that we had all these 2-3 year fixed rates starting to mature. So we then saw the breakout of what has now been referred to as the mortgage wars. And I'm sure every broker in the room is well aware of the cashback opportunities were available, particularly last year, but some of them drifted through into this year. So again, we then saw a lot of refinance activity. So it's really been unprecedented, the level of refinance activity that's been going on in the marketplace. We're now starting to see things settle back to what I would call starting to look like normal. It's still quite high, but it's starting to head back into what I call a normal channel.
Okay, and I think that you raise a very interesting point. The market is in a constant state of flux, and I wouldn't expect that that's going to change anytime in the immediate future. So I guess understanding that correlation between trail book value and market conditions, would you say is a fair descriptor?
Yeah, I mean, it really affects pricing. I mean, we've got to always allow for what's happening in the marketplace, and our pricing has been dramatically affected. So, if I look back over the history of Trail Homes, at the best of times, we've probably paid up to 2.5 times just for buying a straight trail book. And for what I would call the worst of times, we probably have got to being less than 2. So times the annualized trail. So at the moment, we're sitting at about 2 times as the maximum that we'll pay. But we're constantly looking at how the books are performing, how the market in general is performing, and what we expect is going to happen in the medium to near future.
Okay, so in terms of that, that note is probably a good segue to actually just discuss more about how a trail is valued, because before we'd had our discussion about, the nuances of it, to me it seemed to be much more calculated, much more set, much less affected by various factors. So obviously there are the market conditions and the buy and sell correlated prices, but perhaps if you can go through, in addition to market factors, what other areas affect the price or the valuation of a trail book?
So yeah, so it was probably the starting point is to probably just make sure everyone in the room's really aware of when I talk about a trail book, I'm not talking about a mortgage broking business. So this is just to buy the right to receive the trail off an agreed group of loans for as long as those loans may last. Now, the expectation is typically the selling broker, but another broker will be servicing the clients, and the clients will never actually find that we exist. And just to really ram that idea home, if we were to buy your trail book today, Sasha, we would expect you to continue to service the clients, and including the right to refinance. And that means that when you do refinance a loan, the old loan that's discharged, I lose the trail off that. You put in place a new loan, and you get the upfront and trail off that new loan. So it means the book that I buy will, over time, go to zero, and I'll end up with nothing. And presumably, if you're a half decent broker, which I'm sure you'd make an excellent broker, you'd end up rebuilding your book back up to what it was when you sold it to me. What affects the value? A whole lot of major and minor things. So obvious things like age of loans, types of loans, and we do look for that. Most of it comes out, though, from the discussion with the broker about, tell us about your business, how long you've been doing this. So settlement dates I find really a quite interesting one. People always think I like younger loans. I actually like older loans. Younger loans are prone to clawbacks, which we don't like. And I find older books more stable. But the overriding driving force, or major factor, is probably runoff rates, and it's the runoff rates that we're seeing in the market as general, as opposed to the runoff rate relating to that particular book. Everybody tells me that they've got the best performing book, and their book doesn't really run off. But when we're buying it 2 times, the reason we get to 2 times is because we're looking at what the general averages are.
Well, maybe it's a good opportunity just to pause at that point. So obviously, as you've just said, runoff rate is key, but could you just provide a bit more context of why the runoff rate is the primary driving factor when you are valuing a book?
Because it's really, from my viewpoint, I expect the book to go to nothing. I expect every loan to discharge, but it's just about the speed at which it happens. So when you think about it, it's probably the only thing that really matters. There's the price that I pay, which will be a known, and then it's the speed at which it just goes to zero. And if it, I flippantly say that if I, buy a book today and all of the loans discharge tomorrow, I've done my dough. I'm a big boy, but that's what happens. Alternatively, if every single loan lasted for 25 years and I've just paid 2 times for it, I'm smoking cigars. In reality, it's something in between. Unfortunately, it's much closer to the former rather than the latter. But it's all about that runoff rate. And that's why we watch it like hawks. We track each book individually. And we've been doing this now for 20 years and we're still tracking. There's not many left of the old books, but we still track them all and watch them all carefully.
Okay, thank you. So we might just go into the products that we want to be discussing today, because I know that there has been a lot of interest in this when, we've just been speaking within industry. So I really want to unpack what that looks like. So you've mentioned that Trail Books regularly purchases books for circa 2 times their value. But as I said, I understand that you've recently launched 2 products that guarantee a higher sale price based on the feedback that you're receiving from brokers seeing a higher multiplier for their books. So I'd love to hear your thoughts in terms of why you've come up with this product and then how these two products work.
Yeah, and I can't say how excited I am about them. It's in my mind, it's a bit of a breakthrough. I mean, people think I'm an idiot because I get passionate about trail books, but to me, it's a bit of a breakthrough. So, as I've sort of alluded to, whenever I buy a book and I'll say, okay, I'll pay you 2 times, and chatting to the broker, it's almost sort of like half the time the broker will quite genuinely say to me, yes, but my trail book is different. My trail book, for whatever reason, you're going to see less runoff. Now, I suspect that the mortgage broker isn't lying. I mean, obviously they're trying to get a good price. But the problem is, from my end, I can't actually tell whether what they're saying to me is correct or not. So I'm left in this sort of no man's land as, I suspect you're probably right, but unfortunately I've just got to look at the averages here. And then after 15, 20 years of doing this, the penny dropped. Well, if you actually are willing to tell me that your trail book is going to run off at a lesser rate than somebody else, and in fact, some people are really quite robust about, Nick, this book really is different. You are going to see very little runoff in the near future on it. Then the obvious thing is, well, if you, the seller, are willing to guarantee some sort of minimum level of runoff, and we can put in place some sort of real guarantee, then yes, I can pay you more. And so that sort of opened up this whole new world of, what I'm now referring to as GROW products. So GROW being the acronym for guaranteed runoff. And it means, yes, at the extreme, we'll pay up to 3 times for a trail book on the basis that, over 2 years, there's no runoff. And then after that, we expect normal runoff to commence. Alternatively, we've got a second product which we've launched that if the broker is willing to guarantee a 10% runoff over 12 months, then we'll pay 2.4 times.
Okay, so go ahead, Nick.
I was about to say, in reality, we can, tailor up any scenario you like, but it's much easier to understand it if it's 3 times, no runoff for 2 years, or 2.4 times, 10% runoff for 1 year.
Okay, so we've got these two options. Why don't we go through both of those specifically in terms of not only the annualized amount that a broker can get and corresponding runoff, but the other nuances that surround both of the products. So if we maybe focus in on the 2.4 times piece first, and then we'll go to the 3 times.
Okay, so it's probably almost easier to. Should we do a mythical example, Sasha?
Oh,
perhaps?
actually, yeah, that's probably a better way to do it, isn't it? Because I know that it's one of those things that the more you talk about it, the more you can wrap your head around it. But it is quite a new concept. So I want to make sure we do it justice.
Yeah.
So
let's do
let's do an example.
let's do it at a high level, a sort of a mythical example. So let's just say, Sasha, for the sake of the story, that you've got a trail book that's generating $10,000 a month in trail. And let's say that you want to acquire Brian, mortgage broking business. Brian also coincidentally has a mortgage business that's generating $10,000 a month in trail. So you same. So what you do is you say, okay, Brian, I'll buy your book. And let's just say in this particular case, Brian has agreed to sell his business at 3 times. You immediately then sell the trail book within Brian's business to me at 3 times. And effectively, you're going to use that money to pay Brian to acquire his business. And you're going to put, and this is the important bit, you're going to put some of your trail book up as security against the guarantee that you're going to provide that there's going to be no runoff on Brian's book for the first 2 years. So we've set the game in play. Brian's got his 3 times. He's gone. We've also got the scenario whereby you've now legally acquired Brian's goodwill, hopefully his telephone number, website, all the client information, nice warm introduction from Brian that you're now acquired his business or you've merged with him or however marketing spin you want to put on it. Now, month one of Brian's clients rings up and says, I've just bought a beach house and I'd like to refinance everything, to which you say, that's fantastic, I'm here to help you. And you do refinance everything. So the old loan, Brian's old loan, which he sold to me, is obviously going to be discharged. And effectively, the new loan that you put in place, in a monetary sense, is actually going to be, the trail on that is going to be effectively used to fulfill the guarantee with me. So what it means simplistically is when you refinance one of Brian's loans, you're going to keep the upfront, but the trail is effectively, in a monetary sense, going to make its way across to me to fulfill that guarantee that there's going to be no runoff. So when you're refinancing one of Brian's loans, if you refinance it with a bigger loan, it means effectively you're going to keep some of the trail, the uplift, if you like. If you refinance it with a smaller loan, then effectively you're going to have to dip into your own trail book to effectively compensate for that. So if you can grow Brian's business, you're going to effectively, yes, keep all the upfronts, but you're also going to keep some of the trails. If it goes into decline, Brian's business, effectively you're going to have to dip into your own trail book a little bit to make up that shortfall.
Okay, so I guess yeah, go ahead.
Yeah, so the important bit though is at the end of the 2-year period, the guarantee lapses and effectively you now move forward and my trail book will now drift away down, albeit 10,000 at year 2, but it will then start to disappear down to wither away down to nothing as you easily refinance all of those clients.
Okay, so my upshot from this is that the amount you get and the runoff are invariably related. So 0% runoff equals 3 times the amount of the book, and then 10% runoff is 2.4 times. So if you've then got if I'm thinking that I'm a broker and I want to sort of establish that, obviously I can tell that from my figures. So you run a report and you actually ascertain what your historic runoff is, which I would expect would give you your actual runoff opposed to your perceived runoff. I sort of, when we talk about the condition of a book, I sort of liken it with your house. When you're going to sell your house, you think it's always going to attract a higher rate than what the market's going to do. But then if you look at historically or also what the current market is doing, that really gives you the indicator. So in terms of getting that very accurate representation of the runoff, is it just running a report to be able to identify that, or are there other factors that a broker should be considering when they're making sure that they are confident of their rate of runoff in terms of having that discussion with you?
Most brokers, I think, will know intuitively what their runoff rate is. It's about how much refinance work you're doing. If you're very active, which brokers have been over the last couple of years, then it will be high. I think most brokers at this stage would, certainly every broker I talk to is saying yes, the refinance activity has come back dramatically. So we are returning to what is a normal type market, albeit that we haven't been in a normal type market for probably 3 years or maybe even longer. Probably going to have to go back to pre-COVID if we did know what a normal market looks like. But I think at the start, we spoke about things I look for when I'm valuing up a business. One of the other things is how professional a broker prepare or presents themselves, and it's about how regularly they are in contact with their old clients, reviewing their back book, having procedures in place to do that, providing excellent service. That's what it's about, and by doing that effectively, it maintains your trail book, but perhaps more importantly, grows it.
Fantastic, thank you. So we've talked about the merits of this model. Let's talk about the downside, if any.
Well, the downside is there is a guarantee. So if you buy Brian's business, Sasha, and let's take an extreme example, and you're going to pay 3.5 times. But Brian's business is pretty rubbish. It's actually, Brian's been on holidays for the last couple of years, and his clients have been frustrated; they haven't been able to get through to him, and it's probably not much more than a trail book. And you've overpaid. Then, not that it will necessarily be a disaster, but it means that Brian's business is in decline. You've paid a lot for it, and you're going to have to effectively use some of your own trail to effectively fulfill the guarantee that you've got to me. So it's a real guarantee. On the flip side, if Brian's business is a ripper business and you can get it cheaply, then you've obviously got yourself a bargain. But typically 3 times, and the reason we've picked 3 times, if Brian's business is what I call a mature business, you'll find that half of his business, again, we're talking about this mythical Brian, half of his revenue will be coming from upfront commissions. The other half will be coming from trailing commissions. And effectively, Brian's business will have been operating such that as loans drop off, he's been effectively replacing them with new loans so that the trail book looks very stable. So that's a business to me that is worth about 3 times. And under this model, you can therefore finance it 100%. You don't have to go to a bank. You don't have to put directors' guarantees up. You don't have to put your house on the line. All of these actually do have to put director's guarantee in place. So I should correct myself there. You don't have to put your house up, and you don't have to go through that whole process of borrowing money. Alternatively, if you've got piles of money lying around that you can use, well, you're probably better off using that. But we're assuming here that, Sasha, you don't have piles of money lying around to
That's my future state, Nick.
That's why we're buying Brian's
business.
That's why we're buying Brian's business. So the downside is it's a real guarantee. But whether it's financed via trail homes, a bank loan, or just using your own cash, if you overpay for Brian's business, you've overpaid. That's life.
Okay, thank you. And can you talk us through any tax implications that brokers should be aware of with this model?
Yes, I can, albeit that, as I always say, you've got to talk to your own accountant because obviously your own circumstances will dictate what is applicable and what isn't applicable. So I also, as you know, Sasha, I'm a great passionate advocate for look at the tax consequences. It's I'm amazed the number of people who do a deal without actually thinking about what the tax consequences are. Potentially, the tax consequences here can be really quite favourable. So back to our friend Brian and the business that you're buying. So if you use your own, and by the way, I don't care where the trail comes from. So in your scenario, or that scenario, you had a trail book of $10,000, Brian had a trail book of $10,000, you could actually use your trail book. You could sell that to me at 3 times and use that money to pay for Brian. Or you could use Brian's trail book effectively to sell to pay the money to Brian. So if you use your own trail book, you are probably going to incur a capital gain because your trail book is probably going to be on your balance sheet at nothing because when you started your business, there was no trail book. You've slowly grown it, aggressively grown it. But it's never in your balance sheet being repriced. But when you sell it to me at 3 times, that will automatically trigger a capital gain and you'll be up for capital gains tax. The good news, because you're a small businesswoman, is that you'll get a 50% discount on the capital gains tax that you would otherwise have to pay. If you use Brian's book, it potentially means that there's no capital gain because what's going to happen is that the acquisition price of Brian's business, let's say it was 3 times, because you immediately sell one of the assets to me to finance it, potentially you're going to take on Brian's business at 0 value. Now, Brian is going to make a capital gain. He's going to have to pay tax, but we're not worried about Brian. That was always going to happen. But from your point of view, potentially this can have quite a favourable tax outcome. The final bit, which is the one I particularly like, is let's just say we've done this deal and you might have done a couple of other deals over the years, all financed by a similar process. We now wind the clock forward, Sasha, and you're now looking at retirement after a very successful career mortgage broking. Now you're going to sell effectively your whole business. And the bit I particularly like is that bit of the business that relates to the acquisition that you made of Brian's business 10 years ago, effectively that's sitting on your books at zero value. And you're now going to effectively sell that bit along with everything else in your business, but let's just say for 3 times. You will qualify potentially as a small business person for the tax relief and tax concessions that are available at retirement for people who are selling their businesses. And effectively, you'll probably be able to sell it all tax-free, a whole lot, capital gains tax-free. So, and that is an absolute fantastic situation. Alternatively, if you used your own cash, let's say, to buy Brian's business, it will be on your books at 3 times, and that capital gain will be less. So it potentially has a very favourable tax outcome at the back end by immediately selling out a trail book upon acquisition or at the time of acquisition and reducing the price. But I cannot underline enough, talk to your accountant. I'm willing to be involved in the conversation. If you don't have a good accountant, we recommend good accountants, but you've really got to make sure that it's clear in your mind what the accounting, more importantly, tax implications of what these sorts of deals are.
You actually just took the words out of my mouth. You're going to put me out of a job, Nick. So what I was getting at,
I've got you retired.
Well, I'm retiring anyway because I'm so uber successful. But what I was going to say is it's one of those things, and I think particularly if we just put our business caps on for a minute and forget we're brokers for a moment, you only know what you know as a business. And when you are making these incredibly, potentially very substantial decisions, it's absolutely critical to involve the experts. So if I was a broker and I was even thinking of doing this, I would first of all have a chat with Nick, second of all have a chat with the accountant, and then third of all, I would very much welcome that 3-way conversation between the 3 entities to make sure that when you're planning to do this, it's going to be fortuitous, and the accountant might even have suggestions about at which point in your business's time frame you consider this, at which point of the year you might consider this, how this tracks with your life goals, your professional goals, and so on and so forth. So with this knowledge of what's available, if it was me, the first thing I would be doing is having a chat with both entities to say, okay, if this is something I am interested in, when is the most optimal time to consider this, and how can that then be best structured to then minimize the tax? Because I wouldn't have even thought of the tax implications off the back of it. So moving forward, in terms of brokers who are interested in pursuing discussions about either of the models, what should we brief the team in terms of next steps? So minimum deal size, aggregator considerations, etc.
Yeah, so the deal size. There's at the back end monitoring the book over whether it's 1 year or 2 year to watch this guarantee. There's quite a bit of admin from my point of view. It's not so much from the broker, but from my point of view. Excuse me. So we do have a minimum deal size. And the minimum deal size is $10,000. So if it's a book of 9,000, we'll probably say yes, but if it's a book of $1,000 a month, happy to buy that at 2 times, but we wouldn't do a grow deal on it because it's just too much admin for a book of that size. The other one is you've got to, as always with any trail book sale, you've got to have your aggregator's support. If you're involved in a franchise type arrangement, you probably won't be able to get it. Some of the franchise arrangements do allow for it, but some don't. Without the aggregator's consent and support, this is obviously not going to be a fly. So they're the two major caveats, shall we say: the size of the deal and getting your aggregator support.
And I guess just to that latter point, Nick, we've talked a lot about the unfortunate situation where brokers expect that they own their trail and in fact they don't. So even if you're not considering doing this right now, I would very much encourage, the key takeout from today is just make sure that you do own your trail and ask the question of your aggregator upfront, because that will influence not just this decision, but a whole myriad of other decisions.
Correct. That's really, really understand, and this is just a general business thing, who your partner is and what your partner's going to do for you and why that is the optimal decision for you. So I'm certainly not going to say, franchise arrangements are wrong. There's some fantastic franchise arrangements out there that really support you, help and grow your business, and generate leads and all sorts of things. So, they provide a whole lot of benefits potentially that some other arrangements don't.
Thank you. So we're going to wrap very shortly, but we've got time just for a few quick questions. John's come in terms and has asked the question, what's the average runoff rate?
The very, very long term is 20%, but we haven't seen that for pre-COVID. I think probably, pre-COVID. So we haven't seen it for a long time. The worst we saw was up at 30%. So at the moment we're heading back down again, and the average runoffs we're seeing at the moment, it's dropping below 25% at the moment. So it's on the way down. I think it will get down to, in fact, we have this debate internally at Trailer Homes. I think it will get down to 20%. Some of my colleagues think it won't, and their argument is that brokers are much more professional today at looking after their back book than what they have been, and also clients are becoming less and less loyal to their lenders and more open to refinancing to get a better rate, and they say that is a permanent change in affairs. So that's the debate that's going on, and time will tell. But 20% very long term. Whether we get back to 22 or 20, that's what we're debating in Trailer Homes at the moment. But we've probably got another year to go before we get to the answer of that one.
Thank you. And John's just said that his is 14%. So that
is there you
very
go.
Impressive indeed. Can you guarantee that though?
Happy to guarantee that. Talking about average, and this is, John, this is exactly the situation I'm talking about. John will be saying, I'm not selling at 2 times, but I'm willing to guarantee, maybe 10%, 14% runoff. And I'll pay you a higher price for your book.
Fantastic. So we've had a question come in from Jeffrey asking, is it 2 or 3 times the trail, including GST?
Yeah, so yes. So the book that we buy, if it's inclusive of GST, when we work out the price will be inclusive of GST. If we're looking at a book that is not got GST, so it's pre-GST, then the price that we provide you will also be pre-GST. So one is always going to match the other.
Okay, thank you. We've had a question come in from Victor who said, what happens if I wish to buy the rights to income back? When does the right to income cease other than refinance?
With our 2 times just straight sales, we instigated some years ago the opportunity for the broker, after a couple of years, if they wanted to effectively buy back the trail at a pre-agreed multiple, but they're only buying back whatever trail is left when they do the buyback. Invariably means they pay less to buy it back than what they originally sold it to us for. With grow deals, we haven't opened up that opportunity yet. So it's not to say we won't in the future, but we haven't opened that up as yet. I have to think about that. It's an interesting one. Who asked that question?
Victor.
Thank you, Victor. You've got me thinking.
I think I did take a yes.
Yeah.
Okay.
Yeah.
And well done, Victor. It takes a lot to put Nick in the hot seat. So we've got a few more questions come through. So Nick, if you don't mind, we'll just shoot those through because it's great to see so much engagement.
Yeah.
We've had a question come through from an anonymous attendee saying, if you buy a book and one of the loans has its upfront clawback, do you or the seller suffer the clawback?
Yeah, so with all of our deals, if there's a clawback, we ask the broker reimburses us. So if you think about it, the original upfront was paid to the broker, and it's been clawed back. So it's the broker that's got to wear it. Hopefully, it's because they've refinanced the client into an even bigger loan, and they're still in front. But we can have a long debate about the wisdom and virtue of clawbacks, but
it is what it is.
I'm drumming my fingers along with probably every other broker in the room.
Yes, indeed. We've had a question come through from Ash saying, regarding runoff, what do you define by it? Is it including clients paying down debt?
Yes, it is. It is. So when we, your mythical example of buying Brian's business for $10,000 a month. So we're looking for the trail book to generate $10,000 a month for the next 2 years. And yes, there will be movement at the station. Some loans will go up, some will go down. You'll be refinancing. So net of all of that, under this scenario, you're going to be guaranteeing it's $10,000 a month.
Okay, thank you. And the last question that we'll answer from Jason. So he said, so basically, if I want to buy a book of 10K per month and pay $360,000 for it, we are then servicing the clients for 2 years at the risk of runoff. And then after the 2 years, the loans would become our own when refinanced.
That's exactly right. So effectively at the end of the 2 years, we go our separate ways. So I'm left with month 24, a trail book that's generating 10,000, but I expect that to run off, and whether it runs off at 30%, 20% or 14%, time will tell, but it will run off and it will go to zero. And that broker who will be hopefully refinancing them and building up their trail book from Brian's business, as well as taking the upfronts.
Okay, great. Well, we'll need to wrap now. Thank you so much, Nick, for your time today, as always. And we will look forward to getting your insights at a later time. So for everyone who's tuned in today, we'll provide a copy of this video just so you have access to that should you want to replay any of the details. We'll also send through Nick's contact details, so then you can have further discussions as you see fit with him. And we'll look forward to seeing you next time.
And Sasha, if I can also interject, if there are any other questions that have come through, I'll come back to you personally and answer them. Otherwise, please don't hesitate to reach out and just it's email or ring or whatever. I'm always up for a chat. Thank you, Sasha.
Thanks, Nick. See you next time.
Bye for now.